Anyone with an internet connection can place high-stakes financial wagers on almost any global event. You can bet on when a shipping lane will reopen, the exact price of Bitcoin tomorrow morning, or whether the government will confirm alien life. Investors are pouring money into the platforms hosting these bets. Companies like Keli and PolyMarket have quickly achieved valuations in the billions of dollars. At the core of this industry is an event contract. It's a simple yes or no question about a future event, priced from $0 to $1. As users trade, the price fluctuates. An 80-cent yes share signals an 80% probability the event will happen. This simple binary interface makes it feel like a democratized financial system, but beneath the slick design is a highly competitive, ruthless trading environment. Professional sports bettors are migrating to these platforms for one specific reason. Prediction markets don't ban users who win too much, unlike traditional casinos and sportsbooks. The platforms actually welcome the professionals. Their business model relies on collecting a small fee from every trade, meaning their primary goal is generating massive trading volume, regardless of who wins or loses. This distribution curve reveals the mathematical reality of that volume. According to an analysis of over 1.6 million accounts, a tiny fraction of a percent, just 0.1% of users, take the vast majority of all winnings. On the other side of that equation, roughly 3 out of every 4 retail traders will lose their money. These markets are not a level playing field. They are highly stratified arenas where the average user is statistically destined to become liquidity for the experts. Platforms like Keli are quick to point out that they are not the house. They don't take the other side of your bet, nor directly profit when you lose. Instead, liquidity is provided by entities called market makers. This flowchart shows how a central market maker node continuously posts both buy and sell orders, ensuring that smaller retail users always have someone to trade against. These market makers aren't individuals making gut calls. They are highly sophisticated algorithmic trading firms, and in some cases, they are internal trading divisions owned by the platforms themselves. A retail user trading from a smartphone on their lunch break is executing orders against automated systems processing thousands of variables per second. The platforms note that over 90% of their audience only uses the site as an information market to check probabilities. That leaves a very small fraction of users who actually decide to trade against the algorithms. The entire ecosystem relies on those uninformed retail users. Their participation generates the raw trading volume feeding the platform's fees and the market maker's profits. Because prices on these platforms are dictated entirely by knowledge of the future, the ultimate edge is information asymmetry, knowing something the rest of the market doesn't. Regulators recently charged a special forces soldier who successfully exploited this exact vulnerability, extracting hundreds of thousands of dollars from the market. The soldier generated a massive payout by placing highly specific bets on whether a foreign head of state, Venezuelan President Nicolás Maduro, would be removed from office. Traditional stock markets require a chain of corporate insiders to leak earnings reports. Event contracts, however, can be based on geopolitics or military action, making them uniquely susceptible to stolen confidential documents and illegal tips. In an arena driven purely by probability, individuals armed with illegal knowledge of tomorrow's news ensure that honest retail traders have a mathematical guarantee of losing. After a period of explosive, unregulated growth, the U.S. government is now mounting an aggressive legal response to online event contracts. Federal regulators have officially classified these contracts as swaps. This completely removes them from the legal category of sports gambling and places them squarely under federal financial law. The primary federal agency asserting authority over this industry is the Commodity Futures Trading Commission, or CFTC. This classification carries heavy legal weight. The CFTC is the exact same agency responsible for policing the multi-trillion-dollar global markets for physical commodities like wheat, gold, and crude oil. Facing this regulatory pressure, platforms are scrambling to comply. They are rolling out fully compliant U.S. exchanges, updating their terms of service, and permanently banning accounts linked to insider trading. Prediction markets have proven to be an incredibly efficient way to crowdsource human probability, but entering this ecosystem without a distinct, measurable edge turns you into nothing more than liquidity for the professionals.